The IRS doesn't care about you. That's not cynicism, that's the architecture. The system wasn't built to be fair, it was built to be consistent. And what it's consistent about, from the first dollar you ever earn to the last one you'll ever report, is that the rules change depending on where you stand. Not because someone decided it was personal, because the tax code is not one document. It is several documents layered on top of each other across 80 years, and each layer was built by people who had already made it past the level they were legislating for. This is your life at every income level, from $30,000 a year to $30 million. And what the IRS does with your money and to your time at each one. You make $30,000 a year. Before anything else, 7.65% of every dollar you earn disappears into payroll tax, not income tax. Payroll tax, Social Security, and Medicare. That comes out before you file, before you calculate, before you get to decide anything. It comes out automatically, and it comes out at the same flat rate whether you make $30,000 or $300,000. Your federal income tax after the standard deduction is close to zero, maybe $1,000, maybe less. You hear people talk about not paying taxes, and you think that's you. It isn't. You paid $2,295 in payroll tax before you saw a single dollar. The system collected from you first. Your effective federal rate all in sits somewhere between 8 and 11% of gross income, depending on your state. You have no investments to complicate things, no capital gains, no dividends, no rental income. Your tax return takes 25 minutes in a free online form. The IRS has almost no interest in you. You are not an audit target. You are a direct deposit and a W-2 and a number in a system that processes 160 million returns a year without blinking. You make $60,000 a year. The math changes slightly, but the experience doesn't change much. Your effective federal rate is now 12 to 14%. Payroll tax still hits first. You might have a 401k now, which means you're beginning to understand the tax code's most accessible gift, the deduction for money you don't spend yet. Every dollar you put into a traditional 401k reduces your taxable income by $1. If your marginal rate is 22%, that's 22 cents of tax you don't pay on each dollar you defer. This is not a loophole. It is the most publicized provision in the entire code. It exists because Congress wanted to incentivize saving, and it does. Most people at this level use maybe half of it. You file your own return. It takes longer now. Maybe you had a side job. Maybe you sold something. Maybe you got a 1099 instead of a W-2 for part of your income, and now you owe self-employment tax on top of income tax, and nobody warned you about that in advance. The IRS doesn't warn you. It sends you a bill. You make $100,000 a year. This is the number that feels like a rival and isn't. Your marginal rate is now 22% on most of your income. Your effective rate is somewhere between 16 and 19%, depending on deductions. You're paying real money in taxes now, $16,000, $18,000, $20,000. And for the first time, that number has weight. The standard deduction is $14,600 for a single filer in 2024. If your mortgage interest, state taxes, and charitable contributions don't exceed that combined, you take the standard deduction and the itemized system doesn't exist for you. Most people at $100,000 don't itemize. The tax code has a more sophisticated system available to them, and they're not in it. What changes at this level is what you start to notice. You notice that your investment account, if you have one, produces gains that are taxed differently than your salary. Capital gains on assets held over a year are taxed at 0, 15, or 20%. Not at your marginal income rate of 22. You made the same dollar two ways. One way it costs 22 cents in federal tax. The other way it costs 15. The system is telling you something about what it prefers you to do with money. Most people don't hear it clearly until they're past this level. You make $200,000 a year. You are now in the 32% marginal bracket. Not everything you make is taxed at 32%, just the dollars above the threshold. But $200,000 is the level at which the AMT, the alternative minimum tax, starts becoming something your accountant mentions. You probably have an accountant now. The AMT is a parallel tax system that runs alongside the regular one. It was designed in 1969 to make sure wealthy filers couldn't use deductions to eliminate their entire tax bill. It now catches upper-middle income earners in expensive states with high local taxes. You didn't design this system, you inherited it. The net investment income tax arrives at $200,000 for single filers. An additional 3.8% on investment income above the threshold. Your capital gains, your dividends, your rental income. All of it gets a surcharge you didn't have at $100,000. The Medicare surtax arrives too. An additional 0.9% on wages above $200,000. You're still earning money the same way. The rate on the additional earning is just different now, and the differences compound. Your tax return is no longer something you file. It is something your accountant prepares over 3 weeks in February using documents that arrive in stages. You have multiple 1099s. You may have K-1s from pass-through entities. You have a mortgage, a brokerage account, a retirement account, and possibly a rental property, and each one has its own document and its own rules and its own filing deadline. You are beginning to experience the tax code as a system you manage rather than a form you complete. You make $500,000 a year. The top marginal rate is 37%. You are in it. On dollars above $609,000 for a single filer, the federal government takes 37 cents of every dollar you earn as ordinary income. That number, 37%, is the number people use when they argue about tax policy. It is real, and it is the ceiling of what the government charges for ordinary income. What it doesn't capture is what changes at this level. You are no longer primarily earning ordinary income if you're doing this correctly. You have restructured how money reaches you. Salary is for people who haven't restructured. You have equity compensation, deferred arrangements, capital gains timed to long-term treatment and retirement vehicles that reduce your taxable base before the 37% rate applies to any of it. Your accountant is now a team. A CPA, a tax attorney, a financial advisor, and possibly someone who specializes in deferred compensation structures. You spend somewhere between $40,000 and $80,000 a year on this team. That expense is itself deductible in certain structures. The IRS is paying in a small way for the people who help you pay the IRS less. You are not evading anything. Everything your team does is documented, disclosed, and legal. The tax code at this level is not a list of prohibitions. It is a map of opportunities written in language that requires expertise to read. You make $1 million a year. The number people think changes everything has changed mostly the complexity, not the fundamental mechanics. Your effective federal rate, what you actually pay as a percentage of total economic income, is somewhere between 28 and 35% depending on how income is structured. Higher than most. Lower than the 37% marginal rate suggests. That gap is where tax planning lives. At this level, the conversation shifts from reducing income tax to managing capital. You have assets now, real ones, a business interest, real estate, an investment portfolio that has appreciated significantly. The tax on that appreciation doesn't exist yet. It doesn't exist until you sell. You don't sell. The IRS collects taxes on realized events. A gain becomes taxable when you recognize it. Old money understood this a century ago and built the first family structures around it. You are learning it now. The unrealized gain in your portfolio is in effect an interest-free loan from the government. Capital you are using but have not yet paid tax on. The longer you hold it, the longer the loan runs. Your charitable giving, if you do it through a donor-advised fund, becomes a current year deduction, even if the charity doesn't receive the money for years. You accelerate the deduction. You defer the gift. The IRS sees the deduction now. The beneficiary sees the money later. Your estate planning begins in earnest. Not because you're old. Because the estate tax exemption, $13.6 million per person in 2024, is scheduled to drop by approximately half in 2026 when the current legislation sunsets. What you transfer before that cliff is exempt. What you transfer after it may not be. The window is visible and closing. You make $5 million a year. The income tax conversation is not where the work is. The income is real and it is being managed. The conversation now is about what the assets are doing and what structure they live inside. A qualified opportunity zone investment defers capital gains for years while the investment appreciates. A grantor-retained annuity trust moves appreciation out of your estate at reduced gift tax cost. A charitable remainder trust gives you income, gives a charity a future gift, and gives you a deduction today. Each of these structures has a specific IRS code section. Each has been tested in tax court. Each requires precise execution to work and collapses into a taxable event if the execution is wrong. Your team has grown again. You have someone who does nothing but monitor legislative risk, the probability that a provision you rely on gets changed or challenged. You model your tax position under 3 scenarios: current law, proposed changes, and a regime shift. The uncertainty is managed as a financial variable. The IRS audits high income returns at significantly higher rates than average returns. Above $1 million in income audit rates are multiples of the general population. You are not randomly selected. You are systematically reviewed. The documentation standard for your positions has to be audit-ready before you file. Your team operates assuming everything will be examined. You have $30 million. The income number is almost abstract now. Salary is a small fraction of your economic picture. The real activity is at the asset level. Capital is moving through structures, partnerships, trusts, holding companies, and what the IRS sees is not what the capital is doing. It sees the reported event. The structure determines what gets reported and when. At this level, you understand something that isn't explained in any overview of the tax system. The code has 2 constituencies. One constituency is everyone who earns wages and reports them on a W-2. That system is nearly frictionless. The employer withholds it, the employee receives net. The IRS collects without the taxpayer making a single active decision. The other constituency is everyone whose income flows through entities they control. Partnership income, S-corporation distributions, rental income, investment gains. This constituency has a tax experience that is fundamentally different from the first. It requires action, documentation, elections, and planning. It rewards complexity with savings. It punishes passivity with the highest effective rates. The tax code was written in part by people who understand the second constituency very well. The complexity is not an accident. It is a feature of a system that rewards engagement and penalizes disengagement. The penalty isn't a fine. It is the absence of everything you would have kept if you'd structured it correctly. Someone is doing their taxes tonight on a free software platform. It takes them 40 minutes. They get a $600 refund and feel relief. That refund is money they lent the government interest-free for 12 months and are now receiving back. They will feel good about it. Someone else has a team of 7 people who spent November and December making sure the structure is correct before any document is generated. Their effective rate on $30 million in economic activity will be something other than what the marginal rate table would predict. Not through evasion, through architecture. The distance between those 2 experiences is not about the amount of money. It is about the amount of knowledge applied to the same set of rules. The rules apply to everyone. The knowledge that shapes outcomes within those rules is not evenly distributed. It never was. It costs money to access, and the more it saves, the more it costs to buy. The tax code is the same document for everyone. The experience of it is not. That has always been the most important thing to understand about it, and it is the thing nobody puts in the summary at the top.